Hi everyone, today we'll be going over accounts May-June 2020, paper 3 question number 3. This is structured paper 3 which consists 6 questions, each of 25 marks, and we are also given a time limit of 3 hours. So we will be attempting to solve each question under 30 minutes. And this question number 3 is part of section A, which relates to financial accounting. Now without any further delay, let's get started. Ang and Kim had been in a partnership for many years, sharing profits and losses in the ratio of 3:2. The books of accounts of the business had the following balances at 31st December 2019. Alright, let's have the look at the information given below. The business was taken over by X Limited on 1st January 2020, and we are given the condition on which X Limited took over the assets of the partnership. Then we are told that X Limited settled the purchase consideration by issuing 50,000 ordinary shares of $1 each at a share premium of 0.80 per share. So the total rate per share, including the share premium, would be the nominal rate of $1 plus the share premium rate of $0.80, which results in the value of 1.80. Okay, and the remainder in cash. Ordinary shares are allocated to the partners equally. Then trade payables were settled in full by the partnership for 13,000. The other motor vehicle was taken over by Ang at the value of 10,000, and the realization costs incurred by the partnership amounted to 3,700. Now let's have a look at our question. For the first part, we need to calculate the purchase consideration payable by X Limited. So we were given the conditions on which X Limited took over the assets above. So office equipment was taken over at the value of 35,600. One motor vehicle was taken over at the value 20,000. Then the inventory was taken over after increasing its value by 20%. So let's have a look at our existing value of the inventory, which is given right here. It amounted to 11,400. Now we need to increase its value by 20%. Let's do that. So that's going to be our initial amount of 11,400. And we just need to increase it. So that's going to be 1 plus the increment rate of 20%, which we can write down as 0.20. So this gives the value of inventory taken over to be 11,400 times 1 plus 0.20 to be 13,680. Alright, then trade receivables were taken over after allowing a provision for doubtful debts of 4%. So this just means that trade receivables value when it was taken over was 4% less than our initial value given above. So let's have a look at the above information. We can see that the trade receivables was valued at 19,500, and we just need to reduce it by 4%. So that's going to be 19,500 times 1 minus the reduction rate of 4%, which we can write down as 0.04. So this gives the trade receivables value to be taken over is 19,500 times 1 minus 0.04, which results in the value of 18,720. Okay, then we have goodwill. Goodwill is calculated at the average profit for the last 3 years. So we just need to add these 3 amounts and then divide it by 3 in order to figure out our average profit. So that's 26,000 plus 31,000 plus 39,000. And now in order to figure out the average, we just need to divide it all by 3. So our goodwill value is to be 26,000 plus 31,000 plus 39,000 divided by 3, which amounts to 32,000. So if we add all these 5 amounts, then we will figure out the purchase consideration. Let's do that. Okay, so we will be starting with our office equipment. Let's have a look at the above information at its value. So the office equipment taken over had the value of 35,600. Let's write it down in our statement. So that's 35,600. Then we had the motor vehicles. Let's have a look above. The motor vehicles taken over had the value of 20,000. Let's substitute this value into our statement. Then we had the inventory. And we increased the value of inventory by 20%. So it amounted to 13,680. Let's substitute this value. That's 13,680. Then we had our trade receivables. And trade receivables were valued at 4% lower than the initial value. And we figured it out to be 18,720. Let's write it down. And finally, we had our goodwill. Let's have a look above. And goodwill was the average of the last 3 years' profit, and we figured it out to be 32,000. Let's substitute this value. Okay, now we can figure out the purchase consideration payable by X Limited. That is just going to be the sum of these 5 amounts. So that's 35,600 plus 20,000 plus 13,680 plus 18,720 plus 32,000, which results in the total purchase consideration to be 120,000. Alright, this concludes the first part of this question. Now we can move towards the second one. So we need to prepare the realization account. Okay, so realization account has the debit side and the credit side. The first step in our realization account would be to record all of the assets taken over by X Limited at its original value in our debit side. So the assets taken over were office equipment, motor vehicle, inventory, and trade receivables. Alright, let's have a look at our information above. Okay, we can see that the office equipment had the value of 42,400 initially. Let's write it down. That's 42,400. Then we need to figure out the value of our motor vehicles. And this is the value for 2 vehicles, out of which only one was taken over by X Limited. And this amounted to 27,700. Let's write it down. Okay, then we need to record the value for our inventory. So inventory previously amounted to 11,400. Let's record this value as well. And finally, we have the trade receivables. And we can see that the trade receivables were valued at 19,500. Let's record this in our debit side. And these all, except for 1 motor vehicles, were taken over by X Limited, right? And they are paying the purchase consideration of 120,000. Alright, then we still have 1 motor vehicle remaining, right? So let's have a look at the above information. Okay, we can see right here in our 4th point that the other motor vehicle was taken over by Ang at a value of 10,000. So since this was taken over, so this should also be recorded on our credit side. Let's do that. And this is payable by Ang's capital account. So that's capital Ang. This relates to our motor vehicle. And she took over the motor vehicle at the amount of 10,000. Alright. Then we also need to record the settlement of our liabilities. And we can see here that the trade payables were settled in full by the partnership for 13,000. So this is the settlement amount, right? But let's have a look at our initial amount of trade payables right here. It amounted to 13,700. So this initial amount of liability should be recorded on the credit side, and the settlement amount of 13,000 should be recorded on the debit side in our realization account. So we have a pattern here. The original amount of assets is always recorded at the debit side and its settlement is recorded on the credit side, whereas the original amount of liabilities is recorded on the credit side and its settlement is recorded on the debit side. Okay, let's record this. We're talking about trade payables. And initially it had the value of 13,700. and then it was settled by the partnership, right? So that's again trade payables, and it was settled at the amount of 13,000 only. Okay, then we also need to record our realization cost or realization expenses, which is given right here. Realization costs incurred by the partnership amounted to 3,700, and according to our format, the realization cost is always recorded on the debit side of the realization account. Let's do that. So that's the realization cost of 3,700. Alright, I think we've included everything that we need to include in our realization account. So now we just need to figure out whether there was a profit on realization or loss on realization. In order to figure that one out, we just need to figure out which side is the heavier side, debit or the credit side. And in order to do so, we need to figure out the total for both these sides. So let's figure out the total for the debit side first. That's going to be the sum of these 6 amounts. So that's 42,400 plus 27,700 plus 11,400 plus 19,500 plus 13,000 plus 3,700, which gives us the total of 117,700. Now we repeat the same process on credit side. That's going to be the sum of these three amounts. So that's 120,000 plus 10,000 plus 13,700, which gives the total of 143,700. We can clearly see that the heavier side is the credit side, meaning that our balancing figure will be on the debit side. Okay, let's write down the total first. That's the total of the heavier side, so that's 143,700. And same is for the debit side, so that's 143,700 again. Okay, since our balancing figure is on the debit side, so there is a profit on realization. But if our balancing figure were to be on the credit side, that would have resulted on a loss on realization. And this profit on realization should be shared among the partners, Ang and Kim. Okay, firstly, let's figure out the total profit on realization. That's just the difference between these 6 amounts and the total amount. So we already have the sum for these 6 amounts to be 117,700. So that is the difference between this amount and our total. So that's 143,700 minus 117,700, which results in the profit on realization to be 26,000. Okay, now we need to divide this profit among our partners. In order to do so, let's have a look at our profit sharing ratio. Okay, it was given that they share profits and losses in the ratio of 3:2, meaning that out of 5 parts, 3 parts belong to Ang and 2 parts belong to Kim. Let's figure out our profit for our partners now. For Ang, that's just going to be the total of 26,000, and 3 out of 5 parts belongs to her, so that's times 3 by 5, which results in profit on realization for Ang to be 26,000 times 3 by 5, which results in the value of 15,600. Okay, now for Kim, that's 26,000 total profit, and 2 out of 5 parts belongs to her, so that's times 2 by 5. This results in profit on realization for Kim to be 26,000 times 2 by 5, which results in the value of 10,400. Alright, this concludes our realization account as well as the second part of this question. Now we can move towards the third one. We are given additional information. It was agreed that the allocation of X Limited shares to the partners and the final settlement by the partners to or from the partnership bank account will go through the partners' capital accounts. So meaning that this settlement or the final settlement will act as the balancing figure in the partners' capital accounts. Now for the third part of this question, we need to prepare partners' capital accounts in a columnar form. Okay, so we're talking about a capital account. And this has a debit as well as the credit side. And we need to prepare both sides for both of our partners. Okay, so this is the credit side. The first one is for Ang and the second one is for Kim. Now this is the debit side. Okay, again the first one is for Ang and the second one is for Kim. And when we're preparing a capital account, we always start with our opening balances. on the credit side. So let's do that. We can write it down as balance brought down. Let's have a look at the above information. Alright, we are given information regarding capital accounts right here. For Ang, it was 42,000, whereas for Kim, it was 38,000. Let's substitute these values into our capital accounts. So that's 42,000 for Ang and 38,000 for Kim. Nextly, since X Limited is acquiring their partnership, we also need to adjust their current accounts. So let's have a look at the above information. Information regarding current account is given right here. So we can see that the current account balance for Ang is 2,500 on the debit side. This means that Ang owes 2,500 to the partnership business. So this definitely reduces the balance on her capital account, meaning that this amount should be recorded on the debit side of her capital account. Then for Kim, we have our current account balance to be 5,300 on the credit side, meaning that the partnership owes 5,300 to Kim. So this definitely increases her capital account balances, which means that this amount should be recorded on the credit side in our capital account. So let's record these two values in our capital account. We can record it under the heading of current account. And since for Ang it had the debit balance, we need to record it on the debit side. So that's current account, which had the value of 2,500 for Ang. And the current account for Kim was on the credit side. So that's current account with the value of 5,300. And we also know that there was profit on realization, right? This definitely increases the capital account balances for Ang as well as Kim. So it needs to be recorded on our credit side. Let's do that. Profit on realization. Let's have a look above at our realization account. We can see that the profit on realization for Ang is 15,600, whereas the profit on realization for Kim is 10,400. So let's record these two values in our capital account. For Ang, it was 15,600, and for Kim, it was 10,400. Then we also know that only one motor vehicle was taken over by X Limited, and the remaining motor vehicle was actually taken over by Ang, which we recorded in our realization account as well, right? So while taking over the motor vehicle, she definitely has to pay back to the partnership account, which means that she needs to pay this 10,000 back to the partnership. And this payment will definitely reduce her capital account balances. So this motor vehicle taken over will be recorded on our debit side. Let's do that. So we have motor vehicle taken over by Ang at the value of 10,000. Alright, I think these are all the events to be recorded on our capital account. Now we move towards the settlement by X Limited, since that is also to be recorded in our capital account. And we were given information regarding it. X Limited settled the purchase consideration by issuing 50,000 ordinary shares, and we figured out the rate per share to be 1.80. So I have to figure out the total value of the 50,000 shares. So we know that the value for one share is 1.80. So for 50,000 shares, that's just going to be 50,000 times 1.80. So this gives the total value to be 50,000 times 1.80, which is 90,000. Okay. Then we are also told that ordinary shares were allocated to the partners equally, meaning that half of 90,000 is allocated to Ang and half of 90,000 is allocated to Kim. So we know that half of 90,000 is 45,000. So 45,000 belongs to Ang and 45,000 belongs to Kim. So this is given as a settlement, right? So this actually acts as our balancing figure, which needs to be recorded on the credit side of the capital account for Ang as well as Kim. Let's do that. So this is of ordinary shares, which is being given by X Limited. And both the partners are getting the value of 45,000. Okay, let's have a look at the information again. We were also told something about cash settlement. Okay, X Limited settled the purchase consideration by issuing 50,000 ordinary shares of $1 each at the share premium of 0.80 per share and the remainder in cash, right? So there is the remaining balancing figure as well. So in order to figure that one out, we need to first figure out the total of our credit side for both the partners. Let's do that. Okay. So for Ang, that's the sum of these 2 months. That's 42,000 plus 15,600, which results in the value of 57,600, which should be the total for the debit side as well. So any other remaining would be settled by cash, so we can just term it as bank. So this now acts as our balancing figure, right? And in order to figure out the balancing figure, we just need to subtract all of these values from our total. In this case, that's going to be 57,600 minus 2,500 minus 10,000 minus 45,000, which results in the value of 100. Now we repeat the same process for Kim. So the credit total for Kim is going to be the sum of these 3 amounts. That's 38,000 plus 5,300 plus 10,400, which results in the value of 53,700. And this total is to be for the debit side as well. So that's 53,700. Again, the bank acts as our balancing figure, and in order to figure out the balancing figure, we need to subtract this amount from the total. In this case, that's 53,700 minus 45,000, which results in the value of 8,700. And since the partnership no longer exists as it is being taken over by X Limited, we do not have any opening balances for next period. So this concludes the partnership's capital account as well as the third part of this question. Now we can move towards the fourth one. We are given additional information. After issuing 50,000 ordinary shares to Ang and Kim, X Limited had an issued ordinary share capital of 300,000. Ang and Kim were appointed as directors of X Limited and each received 25,000 per annum as director fees. Then X Limited forecasted that the profit for 2020 after acquisition of the partnership business would increase by 60,000 to 260,000. And it is expected that the dividend paid for 2020 will be 0.65 per share. Alright, now for the fourth part of this question, we need to suggest 3 reasons for the forecast increase in profit in 2020. So we can see that the forecast is being made for increment of profit from 60,000 to 260,000. And we need to include the reasons for this increment. So the first one could be that now that Ang and Kim are appointed as directors, their expertise and experiences would possibly increase the total profit. Let's write it down. Expertise and experience from Ang and Kim and now that X Limited has acquired the partnership business as well, they could get access to more customer base since partnership already had an established customer base, which would now be a customer for X Limited as well. Let's write it down. So more customers and finally there could be economy of scale, right? So instead of 2 businesses purchasing separate raw materials, now they merged into one and they can purchase a bulk of raw materials, which could give them additional discounts, resulting in economy of scale. Let's write it down. Of scale. Alright, this concludes the fourth part of this question. Now we can move towards the fifth one. We need to discuss whether or not Ang and Kim had made the right decision to sell the partnership business to X Limited. We need to justify our answer giving both financial and non-financial reasons. So the first financial reason would be to compare the income for partners from the partnership and compare it to the income they are receiving in X Limited. So let's have a look at our above information. We were given the profit for the last 3 years. Okay, we can see that the profit for 2019 was 39,000. So let's figure out the profit for Ang and Kim for that year. We know that 3 out of 5 parts belong to Ang and 2 out of 5 parts belong to Kim. So that's 39,000 times 3 by 5 for Ang and 39,000 times 2 by 5 for Kim. So the profit for Ang in the year 2019 was 39,000 times 3 by 5, which results in the value of 23,400. And the profit from partnership for Kim in the year 2019 is 39,000 times 2 by 5, which results in the value of 15,600. So let's record these values. So we know that the 2019 partnership profit is 39,000, and the share of profit for Ang and Kim was 23,400 and 15,600 respectively. Okay, now let's figure out their income from X Limited. So we know that they are each receiving 25,000 per annum. So for Ang and Kim, they are both receiving 25,000 as director fees. And they are also receiving the dividend, and the dividend is 0.65 per share, and we know that they were given total of 50,000 shares, and 50,000 was divided among them equally, which means that Ang got 25,000 and Kim got 25,000 as well. So the dividend is just going to be 25,000 times 0.65 per share rate. So this gives the total dividend received by Ang as well as Kim to be 25,000 times 0.65, which results in 16,250. So this is the additional income. So both of Ang and Kim will have the total income of 25,000 plus 16,250, which is 41,250 from X Limited. So let's record this as well. The expected income from X Limited in 2020 is 41,250 for both Ang and Kim. Okay, so we can see that previously they were receiving 23,400 and 15,600, but now their income has increased to 41,250. So let's figure out the increment. So Ang will receive, let's figure out the difference. That's 41,250 minus 23,400, which results in the value of 17,850 more. And Kim will receive, let's figure out the difference. That's 41,250 minus 15,600, which results in the value of 25,650 more. Okay. Then we also know that director fee is a stable income regardless of whether the X Limited makes any sort of profit or not. Director fee is stable income. And since they are the directors, they still have the power to participate in decision making. Both can participate in the decision making. Okay, so based on these factors, we now have to decide whether or not Ang and Kim had made the right decision to sell the partnership business to X Limited. So I would say that they made the perfect decision because they are increasing their income without losing the power in decision making, right? So let's write the decision clearly. Ang and Kim made the right decision to sell the partnership business to X Limited. Alright, this concludes the fifth part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.